Hello and welcome to Finance Walk. In this video, we'll check how to calculate cost of equity and cost of debt. See, according to if we want to discount cash flows and maintain it to present level, we need to discount these cash flows by a discount rate, so which is called nothing but WACC, that is weighted average cost of capital. And to calculate weighted average cost of capital, we need values of cost of debt and cost of equity. We also need the respective weights, that is respective percentages in capital structure. Okay, so in this video we will calculate cost of capital, and cost of capital here we calculate by CAPM model. So what is CAPM model? It is capital asset pricing model. Okay, so what is cost of equity and what is cost of debt? Okay, so I will give you let's see the concept first. Cost of debt is nothing but the financial cost or interest rate of that particular loan or debt. Okay, so what is cost of equity? You will ask me what is cost of equity. See, cost of equity is nothing but cost of equity, or the kind of expectation the investors have from your company. So for example, a company is going to raise funds from debt and equity. It has to consider the cost or the expectation of investors. For example, investors would definitely see your company in relation to the market. So what your company is giving in relation to market. Let's say, for example, market is giving 15% year on year or average percentage returns, whereas your company is generating only 8%. In this case, investors would not invest in your company because again equity would attract risk, and if the investor puts the same amount, that is let's say 10,000 in fixed deposit, he would get the same returns, that is 8%. So in this case, equity as a financial product, you need to give higher returns, and the investor will expect higher returns. So ideally we can say it is an opportunity cost of that equity, or opportunity cost of investment. Okay, so after this concept we'll see what is cost of equity, the formula for cost of equity. Okay, as per CAPM, it is risk-free rate of return plus beta into market rate of return minus risk-free rate of return. So what is risk-free rate of return? We'll see how to calculate risk-free rate of return. For risk-free rate of return, we need to take 10-year government bond rate. So currently it is 8%. Okay. So beta we have just calculated of Colgate. We can take beta, that is 0.19. So you can link equal to sign, select this figure, press enter. So 0.19 is beta. Now what is market rate of return? Market has given on an average 15 to 16% in last 30 years. So let's say if Sensex started in 1979, so from that the market has given 15 to 16% on an average returns. So you can take 15% on safer side. Fine. So here cost of equity is 9.35%. However, I think this rate is very low. See, if any company is going to raise funds, then investors would definitely think about the investors' risk and return point of view. So my calculation or my expectation says I would expect at least 12% from this company. So you can take 12% as I would say benchmark figure for this company. Okay, so after calculating cost of equity, let's move to weighted average cost of capital. Okay, so how weighted average cost of capital is calculated? It is calculated by respective by calculated by multiplying respective weights by its cost. So let's say debt. So what is debt for this company? Let's see the weight. Okay, go to balance sheet, check total debt. So total debt is 0. So we can safely say debt after tax is 0. So you need to you need to take the cost of debt after tax, since the tax is since this interest is tax deductible. You need to take this percentage after tax. Okay, what about equity? What is equity's weight? Since it is debt is 0, equity's weight is 100%. What is cost? We have taken cost. This is cost of equity. Okay, so here the total cost comes as a weighted average cost of capital comes as 9.30%. Okay, but as I said already, I would take 12% on a safer side because it would be too optimistic to expect 9.30%, only 9.3% from this company, and whereas market is giving much more than that. Definitely investor would expect higher return. So I would take 12%. Okay, that's all for this video. In next video we'll check how to take input data and how to do projections. Thank you.